Passive index fund investing is one of the most popular ways to invest in the stock market, but it comes with a dark side that most people don't understand. Let me show you. You might have heard of the S&P 500. This is one of the most popular indexes out there because if you buy one piece of the S&P 500, you buy a piece of the 500 largest companies on the stock market. That includes some of the more popular companies like Microsoft, Apple, Nvidia, and Amazon, but it also includes the bottom companies like Bio-Rad Laboratories Class A and Mohawk Industries. Have you heard of Bio-Rad Laboratories? Because if you invest in the S&P 500, you own that company. So these indexes are inflating the value of some of these smaller and lesser known companies because if it wasn't for these indexes, you wouldn't be investing in them because you wouldn't have heard of them. And this is why some people are saying that this passive index fund investing is creating bubbles. But that's just the beginning. If you are the CEO of a publicly traded company, your job security relies heavily on how good your stock is performing. Well, there are two primary ways that you can make your stock price rise. The first way is the most obvious. You work to grow the company. If you can grow the revenues, the profits, and the innovation, you will be a more attractive investment to attract more investors, which should hopefully push up the price of your stock. Or option number two is you become friends with BlackRock, Vanguard, State Street, or Fidelity, which are four of the largest fund managers in America because these are four of the largest institutions that are creating index funds, ETFs, and mutual funds. And so if you can get included in some of their funds, well, that can push more buyers into your stock, which can push up the stock price of your company. Now, my inspiration for this video comes from a phone call that I got from one of my friends where he said he's leaving his company. And I don't say this to be political. I say this just so you understand what's going on. He was leaving his company because the CEO has a new mission to grow the stock value of his company by getting this company included in some of the new funds on Wall Street, which are focused on diversity, equity, and inclusion, because the CEO believes that these new funds are going to drive a lot of buyers into their stock, which can push up their stock value. And so they're changing some of the company culture just so this company can fit into some of these funds. That way they can get more buyers because that will help push up the stock price. That's why today I want to go over 5 things that most people don't understand when it comes to these Wall Street funds. Number 1 is how do these index funds and mutual funds and ETFs work? Number 2 is should you be using them and investing in them? Number 3 is what are some different examples of these types of funds? Number 4 is how do you analyze these funds? And number 5 is how do you build wealth through these funds? So let me start by talking about number 1, how do these funds work? But let me start by telling you this. On August 15th, the United States dollar was severed from the gold standard. Now, this obviously changed the way that our money works, and because of that, I'm hosting a live, free, and virtual investor workshop on August 14th and August 15th. So if you'd like to join me, where I'm going to be going over how money has changed and how you can build wealth in this new changing economy because money is no longer like what it used to be. If you want to see how you can build wealth and learn more and join me on this live free investing workshop, I got the link to how you can join down in the description below. Starting with the foundation. When you invest in a company in the stock market, you are buying a piece of ownership in that company. Now, there's a couple different ways that you can go about in investing your money in the stock market. You can invest your money into an individual company, like investing in the McDonald's stock, or you can invest your money into a fund. So if you invest your money into the McDonald's stock, you can go into the stock market and buy one share of MCD. That's a ticker symbol for McDonald's, which will give you one piece of ownership, one share of the McDonald's company, which entitles you to a little piece of the McDonald's profits. But the risk you take when you invest in one company is if McDonald's starts serving really nasty burgers and people start getting sick and McDonald's goes bankrupt, all of the money that you invest in McDonald's goes to zero. But on the flip side, if McDonald's starts to dominate, they put Chick-fil-A out of business, they put Burger King out of business, they put Popeyes out of business, well, now McDonald's would grow their market share, they would grow their profits, and their stock would also become more valuable, which means you get to make a lot of money because the stock price grew a whole lot. So if you invest in an individual company, you take on a lot of risk, but you can also see more potential upside. The alternative to investing in an individual company would be to invest in a fund. There are 3 different types of funds. You have index funds, mutual funds, and ETFs. I'll explain what the difference is in just a second. But the general purpose of you investing in a fund is now instead of investing in one company, you can invest into a group, a basket of companies. So now instead of just investing in the McDonald's stock, you can invest in a fund that gives you ownership to McDonald's, Apple, Amazon, Coca-Cola, and maybe 500 other companies. So now you can go out and buy one share of this fund, and now you own a piece of, say, 500 different companies. That's the difference of investing in one fund versus one share of a company. And the advantage here is now if McDonald's were to go bankrupt, well, now this McDonald's stock would be kicked out and it'd be balanced out by some of the winners. So you have less risk, but also less upside. Now, all three different types of funds, index funds, mutual funds, and ETFs, work similarly in that you're investing in a basket of stocks, but there are some nuanced differences. And many times people will use the word index fund to refer to everything, but I want to be a little bit more technical here. That way, at least you have the background knowledge to understand what the difference is between each one of these funds. And there are three things that you want to pay attention to. Number one is, are these funds actively or passively managed? Are your fees higher or lower? And how often can you trade in and out of these funds? I'll explain exactly what that means. So index funds are generally passively managed. What that means is they're not managed by an individual person. It's not managed by a particular money manager. Instead, it's managed by a computer. So a computer will create an algorithm, maybe like investing in the S&P 500, meaning a group of the 500 largest companies in the stock market. You don't need a human being to decide what's the 500 largest companies. You can just train a computer to know what are the largest 500 companies. If a company starts to get smaller or they start to go bankrupt, well, then the computer can automatically kick one company out and put another company in. So these are passively managed funds compared to an actively managed fund, which needs a particular money manager to pick stocks. But when you have a computer managing these stocks, your fees are generally lower because now instead of paying a money manager, you're paying a computer, which doesn't cost as much as an expensive money manager. And the third thing that you have to understand about index funds is you can generally trade in and out of an index fund just one time a day. So if you have a stock brokerage account, you might know that if you wanted to trade a stock like McDonald's, you could do it in the morning, the afternoon, the evening, and every time in between, as long as the stock market is open. But when we're talking about real index funds, you can generally only buy or sell an index fund once a day. You can't trade in and out of them like you can a normal stock. Mutual funds work a little bit differently than index funds in that they are not passively managed, but they're generally actively managed. That means now you have a sophisticated money manager that's going to be picking stocks, not based off of some algorithm, but based off of what they believe is going to be the best fit for this fund, based off of whatever goal that you're looking to invest in. And because now you're paying an actively managed manager, well, now your fees are generally going to be higher. Now, you might say, well, what's the purpose of paying these higher fees? The pitch here is because you pay this money manager who's going to charge you a higher fee, the goal is for them to get you a higher return. Is it guaranteed? No, of course not. Investing has risks. But because you're paying these higher fees, the goal is to potentially get higher returns. But just like an index fund, you can generally only trade in and out of a mutual fund once a day. And then you have ETFs, which are kind of like a happy medium between index funds and mutual funds, because ETFs can either be passively or actively managed. Depending on what type of ETF it is, it could be either a low cost or high cost ETF. The passively managed ETFs are going to be low cost. The actively managed ETFs are going to have high costs. And I'll show you how to see these costs in just a minute. So this one is going to be, it depends, depending on what type of ETF it is that you're investing in. And I'm going to show you how to analyze that. But you can trade in and out of an ETF like a stock. So you can trade in and out of an ETF unlimited times during a day as long as the stock market is open. This brings us to point number 2, which is, should you be investing in these types of funds? And I gotta give you a little disclaimer here because investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So, should you be investing in these funds? Now, I can't tell you what to do, but I'll tell you what I do. I invest in these funds. Particularly, I prefer ETFs just because it's a little bit easier for me. I like ETFs, but all of these are great, in my opinion. Now, does that mean that they're always good and all funds are good? No. This is where your analysis comes in to see what is it that you're actually investing in. Because for me, when I have my investing goals, they might be different than yours. I have particular investing goals in that I like cash flow. Most of the funds that I'm investing in are for cash flow purposes, meaning dividends. That means I like to invest in a fund that's going to pay me every 3 months. It's going to put some money into my bank account every 3 months, whether or not I sell. In fact, I don't really like this idea of selling. I'm not a big seller. I want to just buy more and have it pay me a bigger amount of money every quarter. That's the way that I like to invest my money because I'm not a huge investor for appreciation. Appreciation is nice. If my stock market value goes up, great. If it doesn't go up, oh well. What I'm looking for is the cash flow, meaning how much money am I going to get paid every 3 months because I can use that money to spend and I know that I'm going to get more money every 3 months. That's the way that I like to invest my money. But you got to understand the risks. The first risk is an economic risk, which is that, well, if the stock market goes down or the economy goes down and the stock market gets hurt, your funds are probably going to get hurt. But if you want to be a smart investor when it comes to these types of funds, the goal is to be a long-term investor. That means you're not investing for 6 months, you're investing for the long term. That way you can withstand market crashes and market booms, because the reality is markets go up and they go down. We've seen a market crash pretty much every decade for the last century. And the second type of risk you want to pay attention to is more of an industry-specific risk. Meaning, are you investing your money into a fund that actually is going to be producing more value in 10 years, or is it going to be more bankrupt in 10 years? Now, there are funds for pretty much anything that you can imagine. There are funds that give you exposure to the general stock market, like total stock market ETFs or S&P 500 ETFs. You also have funds that give you exposure to things like healthcare and technology and emerging markets and dividends. But then you also have even more niche index funds, or funds in general. You have funds that will give you exposure to things like diversity, equity, and inclusion companies. You have funds that will give you exposure to companies that are investing in electronic cars. You have funds that will give you exposure to artificial intelligence companies. You have funds that will give you exposure to the blockchain. So this is where now, if you're investing in a niche fund, you want to be thinking about, is this something that you believe will have more value in 5 years, 10 years, and 20 years, or will it have less value? Again, I'm not here to talk politics. I'm not here to tell you what's right or wrong. I want you to understand this from a financial perspective, that there are many different ways to analyze and pick these funds, because there are funds for anything that you can imagine. But you want to be investing your money into something that you believe will have a lot more value in the future than today, because if you don't believe it's going to be more valuable in the future, why would you invest your money into it? This brings us to part 3, different examples of funds, and I'm not telling you what to invest in, I'm just giving these to you as examples. An example of an index fund is the Vanguard Fund VFIAX, which gives you exposure to the S&P 500. You can compare that to something like SPY, the ETF created by Spider, which also gives you exposure to the S&P 500. Meaning, both of these funds give you exposure to the 500 largest companies in the stock market. That's what the S&P 500 is. But this one gives you exposure to the S&P 500 through an ETF. This one gives you exposure to the S&P 500 through an index fund. I'll explain how to analyze these in just a second. And then you have a mutual fund by T. Rowe Price called TQMVX, which invests in large cap companies. Now again, this is a mutual fund. It's actively managed, which is investing in large cap companies in the United States. So when you're thinking about what it is that you want to invest in, the first thing you want to think about is, what do you want to be invested in? And then when you're thinking about what funds there are, just use a quick Google search to see what are some of the different types of funds out there, because there are countless different things that you can be investing in. That will get you started on your research. And this is where you want to be paying attention to financial trends and what's happening in the financial markets, because you want to see, where is the money moving to? What are the industries that are seeing the money moving into? Now, there's a couple ways that you can pay attention to this. Number one is by paying attention to earnings statements by companies, reading the press statements by companies. That way you can see the different trends that are happening. The second best thing is to read something like Market Briefs, my free financial newsletter. We also have a newsletter called Market Briefs Pro, which is a paid newsletter where we're covering the financial trends. That way you can see the different shifts of what's happening in the economy. You can see Market Briefs. I got the link for you down in the description. But the whole key here is just understanding how money is moving through the economy, and you want to be investing your money into industries where more money is moving into. Which brings me to number 4, how do you actually analyze these funds? So let's break these 3 things down. I'm going to try to keep this as simple as possible for YouTube purposes, but there are 3 main things that you will want to pay attention to when you're analyzing these types of funds. Number 1 is what industry that you're investing in. Number 2, what are the fees? And number 3, what are the holdings inside of these funds? Starting with the industry, because this is probably the simplest. What is it that you're investing in? Do you want to invest in real estate funds, healthcare funds, technology funds, emerging market funds, international funds, or general stock market funds? Now, once you understand what industry it is that you want to invest in, this is where you're paying attention to the financial trends. The next thing you want to pay attention to is, what are the fees associated with this fund? Because what you'll see is that every single fund has to disclose what their fee is. If you have a 401k, you're paying fees on it. It's called an expense ratio. Every single fund is going to cost an expense ratio, and it's money that's automatically going to be taken out. It's not a check that you have to write. It's not something that you're going to have to enter a credit card in for. It's money that's automatically pulled out for every $1 that you invest. There's a percentage of that dollar that's going to be going directly to the fund manager for managing this fund. Now, I'll explain the true cost of these fees in just a second, but the third thing that I want you to pay attention to are the holdings, which is, what are the companies that are actually being invested inside of this fund? Because you want to make sure that you're investing in a fund that's giving you alignment into the company companies that you want to be invested with. So let me actually just compare these two, because these are both funds that are investing in the S&P 500. So what's the difference besides these fees? Well, if you go onto the fund pages and you scroll down to the holdings, what you'll see is that they value certain companies differently. For example, in SPY, the 10th largest stock holding is Eli Lilly. But in the Vanguard fund, the 10th largest holding is JP Morgan and the 9th largest is Eli Lilly. That means both of these funds are essentially investing in the same companies, but they're prioritizing certain companies more than others, which is where you can pay attention to the holdings. Now let me show you what the cost of this expense ratio really is. If we assume that for all three of these, you are going to invest $1,000 a month for the next 40 years, and you can average a 10% return, well, after paying a 0.04% fee with this index fund right here, you would end up with $5.25 million. If that fee got bumped up to 0.095, because remember both of these are investing in similarly the S&P 500, well now your total return is going to drop to $5.17 million just because you had a slightly higher fee. But if you invested your money into a mutual fund where you're paying 0.72% in fees, well now your total return has dropped down to $4.37 million. So you've lost out on hundreds of thousands of dollars, assuming that you got the same 10% return here, here, and here. So in order for this to make sense for you as an investment, you better be getting higher returns. So if you're looking into these actively managed mutual funds where you're paying higher fees, that's fine. Just understand that you better be getting higher returns to justify the higher fees, but that's not always guaranteed. And this brings me to part 5, which is how do you actually use these funds to build wealth? Because there's a right way and a wrong way to do funds. The wrong way to invest in funds is to take some money, $1,000, $10,000, and you just invest it into one of these funds and you let it sit there. That's not the way that you get rich or build wealth with these funds. The way that you really build wealth here is you create a passive investing system, a set it and invest it system where you find a strong fund that's going to continue to produce value over the next number of decades, and then you invest some money into this fund every week or every 2 weeks or every month, but you do a set it and forget it system. So now you start investing some money into this fund and you stay consistent week after week, month after month, year after year, decade after decade, but you have to stick with it even when things get tough. That means even when you see a market turn down, a market pullback, you keep investing, because that's when people panic, they freak out, they see their funds get cut in half, they see the markets get cut in half, and they panic, and that's where most people are selling. But that's the time where you don't want to stop buying. In fact, that's the time you want to be buying even more aggressively, assuming you're investing your money into a strong fund. So you want to keep investing when markets are up and down in order for you to see the wealth in these funds. It's a set it and forget it system for the long term. That's how you build wealth with these types of funds. This is not like how you invest in individual companies. When you're investing in individual companies, it's a very different analysis, it's a very different game, it's a very different strategy. But the way that you build wealth here, you want to set it, forget it, and invest for the long term. But that's how you can build wealth using these types of funds, assuming you know how to analyze the right funds. Now, of course, one of the things that can help you here is investing in your financial education. And I got a couple of resources for you, like market briefs and our investing workshop down in the description for you. Your credit score is not a measure of how much money you make, and it's definitely not a measure of how wealthy you're going to become. Your credit score shows how likely you are to pay back your debt. It's not even that accurate. Oh, did you just cancel a credit card? Well, now your credit score just dropped 45 points. You've only had a credit card for 3 years? Minus 61. You don't have any debt. You have a 0 credit score.